1. The mortgage interest deduction. In the process of paying off your mortgage, a portion of each monthly payment you make goes toward the principal of your loan, while the remaining amount goes toward interest. It is just the interest component of the loan that is deductible on your taxes. If you signed your mortgage on or after December 16, 2017, you may be able to deduct interest on up to $750,000 of mortgage debt from your income. For mortgage debt up to $1 million in value that was signed previous to then, you can deduct interest on the entire amount. There is a reason for this discrepancy. The Tax Cuts and Jobs Act, which was passed in 2017, completely rewrote the tax system. The interest on mortgage debt of up to $1 million that was signed before to the revamp was grandfathered into the old system, which allowed for a deduction of up to $1 million in interest on mortgage debt. Not having to figure out which amount of your monthly payments goes toward mortgage interest and which portion goes toward principal is a huge relief. Your loan servicer will send you a tax form that contains a summary of the information you provided. 2. Property tax deductions. When you own a house, property taxes are an essential obligation that cannot be avoided. You can deduct up to $10,000 in property taxes per year, but the $10,000 limit also applies to any state and local taxes that you may be attempting to claim as part of your tax deduction. If your property tax bill is $8,000, but you are only deducting $4,000 in state taxes, you may only deduct $6,000 of your property taxes from your income tax bill. 3. The home office deduction. Self-employed individuals may be allowed to deduct the cost of having an office at home from their taxes. It is possible to compute your deduction in one of two methods. Once you have calculated your overall housing expenditures, which include anything from utilities to internet service fees, you may calculate your deduction depending on the percentage of your house that your office occupies. Alternatively, if you have a 2,000 square foot house and your office occupies 200 square feet, you can deduct 10% of your qualified costs from your gross income. If your home costs total $10,000, you will be eligible for a $1,000 tax deduction. There is also the simple way, which enables you to deduct $5 per square foot of office space up to 300 square feet and allows you to deduct $5 per square foot of office space beyond that. In the above example, your deduction for a 200 square foot office would be $1,000 in total. Always keep in mind that you can only claim a home office deduction if you operate as a freelancer or as a self-employed individual. As a result of the epidemic, many paid employees are currently working from their homes. However, if you are employed, you are not eligible for this deduction. 4. Mortgage points. Mortgage borrowers may be required to pay discount points in order to obtain a cheaper interest rate on their home loans. Your mortgage points may be eligible for a tax deduction if you paid them at the time of closing on your home purchase. 5. Home equity loan or HELOC interest. House equity loans and lines of credit, HELOCs, allow you to borrow against the value of your home and utilize the money for whatever purpose you want. However, if you use a home equity loan or home equity line of credit, HELOC, to make improvements to your property, you may be able to deduct the interest you paid on the loan. If you spent the money on something other than home renovations, you will not be able to claim the deduction.